All right, we're talking your money this morning as a lot of people are still thinking 2023 is not going to be a great year for the stock market. But our expert, the president and CEO of Heritage Capital, Paul Schatz, thinks otherwise. And he is being very steadfast that you like to make your predictions and stick with them. You're not doing any revisionist history. And while, Paul, you're not actually going to give us a number here, my understanding is you're looking at a number of scenarios, but you think all of them are going to end with good news, at least as far as the Dow is concerned.
That's right, Tim, and Happy New Year to you and everybody else. Yeah, 2022 was a really tough year. Stocks were down 20 to 30%, but the big one was it was the worst bond market year and the longest bond market decline in history. So, yeah, I'm saying in 2023, we have a changing of the tides. It doesn't mean that we have to go straight up all year, but I see a mild recession that still leads to the stock market being up. No, I'll split it, my three forecasts, and say we're going to be up double digits on the year. And if you wanted me to pen in further, I'd say 15 to 20% when the bell's rung on December 31st.
Okay. Here's my question. It looks like, despite all the predictions that we're going to go into some form of recession by people other than you, it seems like every single month the job numbers keep coming out and they keep surprising people in a good way. It looks like inflation is cooling off at least the rate that people were hoping, if not even more so. Why are people still being so bearish then?
And primarily, it's twofold. One, it's that recession is likely coming, but the average mild recession chops 25% off the stock market. On October 13th at the stock market low, we were down 25%. So if that was a pricing in a recession, we've already seen most of, or maybe all of the damage. I said on October 13th that this is either the bear market low, we're done, fini, adios, or it's a low of significance where you get a multi-month rally. So we're certainly still holding that on. That's still valid. People are negative because the Fed's still going to raise rates to make up for their, millionth cataclysmically bad decision not starting this in 2020. And that we're going to see corporate earnings weaken. We're going to see the economy weaken. You mentioned the jobs picture. That's the last. I don't know what the proper way to describe it is, but that's the last man standing. It's a bit of a head scratcher that the job market can remain and has remained so strong in the face of every other economic indicator weakening. But look, the job market is going to weaken this year because of all those Fed rate hikes last year. It takes 6 to 9 months. It's not immediate for a Fed rate hike or cut to filter into the economy.
Now, soft landing is not a technical term with an exact definition, but are all three of your scenarios, would they fit under the term of at least a soft landing by the Fed with regards to the interest rate hikes?
So the elusive soft landing is like landing at 747 on an aircraft carrier. Yeah. It's hard. The Fed did it, Tim, in 1995. The Fed doubled the rates in 1994 to February of 95, similar to today. They did engineer that soft landing. Stocks went up 35% in 1995. Now, this time, nothing is perfect as a repeat, but there is a scenario that if there is no recession, I think stocks go up 20 to 30% this year. Only a deep and protracted recession would be outside of most of, at least of my reasonable possibilities. Jobs are too strong and they're not going to get weak enough to have a really strong recession like we saw in 2008.
That would be really something, considering what we started last year with the Dow at about 36,000. Right now we're at about 33,000. So it's already rebounded quite a bit now. And you're saying if it could go 20-30% on top of that, that would be great for Tim, a lot of 401ks.
Since WW2, World War II, it's 75, 80 years ago, we've only seen back-to-back down years. 73, 74, 00, 01, and 02, we had 3 straight. Back-to-back down years is really outside the norm. But more important, since Germany invaded Poland in 1939, the third year of a presidency has never been down in the stock market. This is Joe Biden's third year. It has not been down since 1939. So we had a weak year last year, and that typically leads to a strong year the year after. all the pieces are in place for a strong year, even if we have a couple of bumps in the road in Q1, where we're in right now.
All right. Well, see, I like that historical precedent. Now let's switch things up and talk about something with not nearly as much historical precedent. Bitcoin, crypto. What do you see in 2023 for that?
I've been waiting for a long time, not wishing because I don't have a dog in the fight, but I've said Bitcoin and crypto looked a lot like the dot-com bubble from 1998 to 2000. And they always end in tears. They never end gently. So we saw the collapse. We saw the fraud. We saw the malfeasance like we did in 2002 with Enron and WorldCom. So now I think if you've always been waiting to buy some Bitcoin, and when I mean some, I mean single digits in your portfolio, it's not a bad time to drip in on a month or a quarterly basis. I think Bitcoin probably has one more decline this year, perhaps below 16, 15,000. And then I think you're going to get a rally in Bitcoin somewhere between 20 and 30,000. You're going to really eliminate all of the weak-handed, the Wild West speculators from this asset class. And then there's going to be pretty strong regulation. That's the dot-com. I didn't get caught up in it. I waited until there was the rubble and the ruin, and you pick out from there. Bitcoin's the granddaddy of the cryptos. That's where I would stick. It should be a pretty kind year to the crypto sector, especially Bitcoin.
Stability, that doesn't sound like fun. What are people supposed to YOLO half of their life savings into now?
Or a HODL, hold on for dear life. But
HODL, yes, yes.
If the asset class is going to remain, this is when, this year is, I'm not saying this is the exact point in time, but this is the year where if you've always wanted to own it, drip a little bit, folks. Keep it to single digits, 3 to 5% of your portfolio.
Last quick question. Tesla's down 70%. I thought I saw you tweet the other day that you bought some up. Is it a good time to buy?
We bought Tesla on Friday. Again, it's like everything else. If you believe in the company long term, the stock's down, an amazing, this is a grand collapse of 70%. Part of it's because Musk bought Twitter and he's not focused anymore. And also it's because of the global supply chain issues, especially in China. If you like Tesla, I think right now is a good time to either add some or buy a little bit. And because if we're not going to rally from here, then 10%, 15% from here, there are other issues that I certainly have not figured out yet.
Would that be considered like a dead cat bounce, I think they call it?
No, I mean, the dead cat bounce is just literally a very feeble kind of unimpressive bounce. I think, where Tesla bottoms, we're not going to have this little bounce and then just go sideways. Tesla should get some traction. And I think we've priced in, lower sales in Europe, lower sales in China, lower sales in the United States. Again, if this recession is mild, Tesla's going to be the beneficiary coming out the other side.
Okay. I just like saying dead cat bounce. I don't know anything.
I call it a dead rat bounce because besides our 2 dogs, we have 3 cats as well.
That works. All right, Paul Schatz, President and CEO of Heritage Capital, LLC. Thank you for taking time to join us with the look ahead at 2023 after helping us button up 2022 so well.
Thanks, my friend.
All right, thank you. All right, Matt Scott.